Hi everyone, hope you guys all having a great day today. In today's video, I'm going to cover the overall market in terms of like the SP 500, Dow Jones, Nasdaq, as well as additional information in terms of interest rates, Federal Reserve viewpoint in terms of the economy and interest rates, plus Jamie Dimon, who is the CEO of Chase Bank, his viewpoints as well. And I'm going to go over what's expected or what's going to happen throughout the day for tomorrow in terms of the market. So first thing we have tomorrow pre-market at 8:30 a.m. we have the CPI number, which is the Consumer Price Index. It gauges inflation for the most part. That's coming out 8:30 a.m. tomorrow. Again, markets open at 9:30 a.m. And as well as, actually, let me just go over a couple numbers first before we start off the whole entire video. So we have crude oil at $85 per barrel, 85.32. And then we have gold at 2,372. We have Bitcoin at 69,219. The halving is happening at mid-April, give or take. And in terms of option tradings, I think they're expecting hypothetically the ballpark of Bitcoin for the most part. When I saw it's right about here to be somewhere between 70, 80 to 90,000. And we have some option trades going up to 140 to 200,000, which is pretty high. But yeah, we shall see. And in terms of the S&P 500, we're at 5,223 points. The Dow Jones at 38,883 points, and the Nasdaq at 18,169 points, give or take a couple decimal points. And then U.S. Treasury 10-year is at 4.362. And then in terms of investor sentiment, I just got it from the American Association of Individual Investors. It's currently, as of April 3rd, the reason I'm going over this one is because it relates to Jamie Dimon's letter, but as of April 3rd, 47.3% for the survey was considered bullish in terms of investors, 30.5% was neutral, and bearish was 22.2%. And as you can see throughout all the reports in March 27th, March 20th, March 13th, constantly more bullish than bearish. So people are quite optimistic the whole entire time. Again, that is touching base off the letter I'm going to go over for Jamie Dimon. And in terms of CPI numbers, again, they come out 8:30 a.m. and previously it was 0.4%. For the month of March, they're expecting 0.3%, so a decrease. And then core CPI is 0.4% previously, and a decrease of 0.1 to a total of 0.3% for the month of March once again. CPI year over year is 3.2% previously. Now they're expecting an increase of 0.2 up to 3.4% total. And then core CPI year over year, 3.8%, decrease of 0.1, which is total of 3.7. Now we have 8:45 a.m. Fed Gov Michelle Bowman speaks. At 10 a.m. we have the wholesale investors for month of March. Previously it was negative 0.3%, and they're expecting a positive 0.5. We do have a jam-packed day because we have the minutes as well at 2 p.m. But at 12:45 p.m. we have Chicago Fed President Austin Goolsbee speak. Then at 2 p.m. we have minutes of Fed's March FOMC meeting. And then at 2 p.m. we have monthly U.S. federal budget. Previously it was negative 378 billion, and they're expecting this time around expectations for month of March at 220 billion. So a jam-packed day for sure. We shall see. The market's going to be moving like crazy, I think, in my opinion. And like always, I'm not sure if I've already stated, I'm not a professional, so please do your own due diligence and research before buying and selling. This is all just my opinion. Now, if we go to, I already covered the sentiment, Federal Reserve interest rate. Before I read the letter, just FYI, where we stand at the moment, we've pretty much hit 0% when it was like June 2020 or April 2020, and then ever since February 2022 we started climbing up, and we're at 5.33%. We haven't hit these numbers hypothetically even before 2006 to 2007, give or take, because we hit like 5.25%. Right now we're a little bit slightly above, so technically it would be back in 2000 time frame, but in 2001 time frame. But in 2001 we were above 5.33. So the closest one is hypothetically, which is around the ballpark, 2006 to 2007. So interest rates are technically quite high in a way. The reason why they increase it though is because if a crash does happen, at least you have something in your arsenal to like lower the interest rates, would stimulate the economy to like start investing more in terms of company growth and so on and so forth. And even for companies that already exist. So not only just creating companies which will create new jobs and so on and so forth, but even existing companies so that they could take that money and invest in research and development and hire new, get more workers and all that stuff and so on and so forth. So that's the benefit of it. It's not necessarily negative for increasing interest rates, but it does slow down the economy. You don't want to slow it down too much, but at the same time, you don't want it to be advancing so much to increase inflation. Now, in terms of Jamie Dimon's letter, we have, where is it? Right about here. So originally, the title basically says JPMorgan's Jamie Dimon warns that the world is on fire and plenty of people are way too bullish. As you saw, the sentiment is pretty bullish, but I think it's naturally always bullish anyway. In his annual letter to JPMorgan shareholders, Jamie Dimon rang the alarm on geopolitical tensions. The bank CEO said investors were too optimistic about inflation, interest rates, and the economy. Dimon hailed AI as revolutionary and flagged recession or even stagflation as significant risks. Jamie Dimon is deeply concerned about the international relations and worries investors are too optimistic about threats such as inflation, interest rates, and recessions. So JPMorgan CEO made his case in a Dow shareholder letter published on Monday. We may be entering in one of the most treacherous geopolitical eras since World War II, Dimon said. He points to the wars raging in Ukraine and the Middle East and the US and China butting heads over issues like trade and resurgence in terrorist attacks. Sharp increases in food and energy prices, steeper borrowing costs, increased recession odds, and whipsawing markets have all also heightened global fear and uncertainty, Dimon said. The billionaire banker outlined why he was especially worried about stubborn inflation. He ticked off government's deficit spending and epic amounts of fiscal stimulus in recent years, the remilitarization trend, the ongoing overhaul of global supply chains, the cost of the green energy transition, and the possibility of higher energy prices in the future because of underinvestment in the energy infrastructure. Dimon also called out equity and credit markets from pricing in a 70% to 80% probability of soft landing, where the U.S. economy skirts recession and both inflation and interest rates fall. I believe the odds are at a lot lower than that, he said. The bank chief cautioned, so I have something to say about interest rates, by the way, because in terms of Fed interviews and all that stuff, but I'll touch base back on it. The bank chief cautioned against paying too much attention to monthly inflation figures or the timing of the next rate cut. He said that the larger forces he's worried about may have locked in longer-term rates already and that minor tweaks might not matter much. Indeed, Dimon said JPMorgan was ready for rates 2 to 8% or even higher. He said that a 2% point increase in rates had slashed the values of most financial assets by 20%, and particularly vulnerable real estate assets like office space by possibly even more. The Federal Reserve has raised rates from nearly 0 to north of 5% to combat inflation, as I showed earlier. If they raise further, Dimon said, there will be plenty of stress, not just in the banking system, but with leverage companies and others. He flagged the possibility of stagflation, which could usher in higher rates, larger credit losses, and slump in business volumes and tough markets. And then the rest is basically just praising AI in terms of the possibility of what it could be in the future. It's like a powerhouse and all that stuff, so on and so forth. Now, in terms of interest rate, we were, not necessarily like we were, but like the market was expecting a good amount of rates this year, give or take. And I think I heard somewhere up to like 6 rate cuts this year or something like that. But I don't know if that was necessarily true. But now we're dwindling down to 2, potentially 1, if not none. So from the interviews I've listened to, like even Yellen, who used to be part of the Federal Reserve, and then Jay Powell, and as well as this article right about here. Where is it? So we have a recent Federal Reserve. Yeah. So Fed's Bostic still expects 1 rate cut. Sorry if I mispronounced the name. Sorry about that. So expects 1 rate cut in 2024, but doesn't rule out 0 or 2. I think he's just mentioning 2 for the sake of being not shocking the market hypothetically. But I think it's either 1 or 0. But that's just my personal opinion. So Atlanta Fed President Ralph Bostic still expects 1 rate cut in 2024, but is not ruling out the possibility. So yeah, so like still expects. I don't know. Maybe whoever wrote the article didn't expect maybe to be read into that too much, but is not ruling out the possibility of 2 or 0 depending on the direction of the U.S. economy and inflation. At this point, I think it's 1, but as months pass, I may move to 2 or might move to 0, and we'll just have to see where the chips fall. Bostic, a voting member of the Fed's interest rate setting committee, said Tuesday in an exclusive interview of Yahoo Live. If the economy continues to accelerate, Bostic said he can't take off the possibility that rate cuts may even have to move further out. But if inflation starts to decline like it did during the second half of 2023, or if there is pain in the market, in the job market, he said he could pull forward his inflation policy outlook and vote for cutting rates sooner. When asked if that meant more than one rate cut was possible this year, he said it's possible. So the thing is, though, the reason why a consumer price index is kind of somewhat important, but if they see inflation increase in terms of CPI numbers tomorrow, the chance of rate cut for throughout the year diminishes, right? So that's the problem. And from Yellen, when she was interviewed, she was a former Federal Reserve, she didn't seem like rate cuts, she wasn't ruling out rate cuts or anything, but it didn't seem like rate cuts could potentially happen fully from the way she was talking. And then Powell, it's the same thing. It's just like there's no real conviction that rate cuts are 100% happening. It's just more like we'll see constantly. So from me, the way I'm seeing it, and we were expecting, or at least the market was expecting a decent amount of rate cuts, yet haven't had any. I think it would be like 1, if not 0. But that's just my opinion again. Now, in terms of the S&P 500, right now, the question is, so essentially, what I'm going to show is the zoomed out viewpoint for the whole entire thing, because if I show everything in detail, it'll pretty much throw out the window tomorrow, because the CPI numbers are going to just affect everything completely. And so that's the reason why I'm showing out the zoomed out viewpoint. And then the thing is too, there's pre-market. So there's pre-market, and pre-market lasts, I think, for 5 hours, give or take, before the market opens. And then we have the CPI numbers at 8:30. So whatever is the pre-market, I guess, might be thrown out the window too, technically, because until the CPI number comes in, then we'll see a spike to the upside or downside based off the numbers, or potentially neutral. And then after that, it comes into play normal. But then we have a bunch of stuff like the Federal Reserve, minutes of Fed's March FOMC meeting at 2 p.m. So it's going to be a busy day tomorrow. But either way, so in terms of zoomed out viewpoint, if you've seen my channel before I covered BlackBerry quite a bit, actually, so I haven't been back on this for some time, but this dates back to like 2010. So we did spike up before, and when I show the SPY, this is encompassed in, but I don't know why it's not necessarily. But either way, we technically are going to upside. But in terms of long term, if I go to the 1 year chart, it's showing technically recovering soon. But then if we go in a 5 year chart, we're due for a dip. So when is the dip going to happen? It's debatable. I'm going to show the SPY so that way I could. SPY is basically an ETF that's just basically a smaller multiple of the whole entire thing. So we have spiked up above some resistance levels. And I think at one point we could be going down. The only thing is, though, they do keep propping up the markets. So when will that dip down happen? It's kind of not necessarily easy to tell at the moment. I would try to predict it right after the CPI numbers. But technically, we have room to grow. So we have room to grow, but we are kind of due for like some kind of pullback, right? And I know I'm all over the place right now. I'm trying to find the best viewpoint, but as you can see, we've been going up since October of 2023, which is kind of insane. You pretty much like, so let me show the SPY, actually, not the SPY, S&P 500. So if you bought in on, I don't know, October of 2023, November of 2023, at 4,117 points, you could have rode up all the way to 5,280 points. That's insane. All the way till now. Just bet on the SPY. So like, SPY is an ETF, right? And you just could have bought, again, 411, held all the way to 520.26. That's crazy. So there's that. Then we have the Dow Jones. In terms of the Dow Jones, we're due for a pullback as well. So usually, for the most part, they're around the same in terms of moving together for the most part. But again, it's technically due for more pullback, even though we have been pulling back a little bit since March 24th. But the thing is, though, is like it's still pointing to the upside. So here's the MACD line, and it looks like it could go to the upside, and it's still waiting to go to the upside. So if we go to the 1 year chart, though, it looks like it's going to go up to the upside as well, and then the 5 year chart is showing downside. So in the 5 year chart, it looks like we're going to be pulling down at one point, and then the levels we'd be pulling down to is 3,000. So currently we're sitting at 3,883 points, and the pullback would be down to 37,356 points, give or take. But again, this moves gradually. I will cover these more in depth later on after the CPI numbers. So tomorrow I should have a video up tomorrow as well, and then I'll show more details. It's just because, again, everything's pretty much going to be thrown out the window tomorrow based off the numbers, right? And then we have the Nasdaq. We're pretty much pushing like at the bare limit right now. So this goes back all the way to 2010 as well. We broke through the resistance level during the 2020 phase, and I believe 2022. Where is it? Right about here. So 22. So yeah, so from 2020 to 2022, we broke above it in terms of resistance level. Now we're back underneath it. And right now we could potentially break through, but like here's the 5-year chart, and it's showing that we're potentially going to be going down. So the Nasdaq is for tech stocks for the most part, and we are due for a pullback basically, right? So the question is where. Right now we're sitting at 18,169 points, and we could probably come right about here, potential support level right about here, and then resistance, or yeah, resistance and support level. We could, and then hit the moving average a little bit, so 16,000 points, which is a big drop for the most part. But again, I don't think they're necessarily gonna try to bring down the markets, because with election year, and usually administrations try to like I'm not saying they like fully get involved in the markets, but there is I forgot, there's like an agency that to make sure that things that don't drop fully. So I don't think they want anything to go crazy during the election years personally, but again, that's just my opinion. But yeah, so there's that. So in terms of the overall trajectory, in terms of a little bit long term, and a little bit long term, I would say like the coming months, there's supposed to be a pullback in all 3 sectors, it looks like, except I guess maybe the Dow Jones. Let me just double check the Dow Jones before I say that. One sec. So for the Dow Jones, yeah, same thing. So they all have pullback a little bit, and that's the coming months. But in the near term future, like let's say within the next 30 days, they're showing more upside to hit the ceilings, it looks like, for the most part. And if that's the case, we still got more room to go, which is crazy. For example, if you look at the SP500, it's the same thing. It's just back in October and November of 2023 and going up till now. That's impressive. So yeah, there's that. So hopefully you guys liked the video. Hopefully you guys enjoyed it. It might have been all over the place. I apologize for that, but I'm going to be more concise and more organized throughout the next videos. And hopefully in the future, probably do these live, so you guys could probably ask questions later on too within the stream. But yeah, hopefully you guys enjoyed it. Hopefully you guys liked it. If you did, consider dropping a like, helps the channel. Thanks so much for that. And consider subscribing to be notified when I do upload my next video. Until then, I'll see you guys in the next video. Peace.